Hello, everyone, and thank you for joining the Reducing Customer Acquisition Costs webinar. Phone lines will be muted for the duration of this webinar, but you can still ask questions. You can submit them using the Q&A bar, and we will respond to all of those offline after the presentation. Now I'm going to go ahead and turn things over to our first presenter, Michael Vermillion.
Thanks so much, Carolyn, and thanks everybody for joining us today. I'm Michael Vermillion. I lead the insurance practice here at JD Power, and with me today are Steve Crutzen and Ken Lee. So Steve, maybe just a quick introduction, and then Ken, and then we'll get to the content.
Yeah, thanks, Mike. Great to be here today with you and Ken. I've spent most of my career here at JD Power working with auto insurers on better understanding the customer, their needs, their desires, and how to better serve a customer, and in doing so, growing their business. So happy to be here to talk about customer acquisition today.
Awesome. My name's Ken. I'm a recovering academic. I'm classically trained as a behavioral scientist, and I've been working in the AI space for over 15 years now. And I've spent the entirety of my career measuring, modeling, and predicting human behaviors.
Terrific. Well, guys, thanks so much for joining us today on this important topic. So what we had in mind in terms of an agenda, we just want to talk about the challenge and then the opportunity. And then we want to kind of dive into this topic of lead scoring and really kind of explain what we mean by that. Then we'll look at some best practices in terms of how to take it from theory to practice and make it work. And then we'll just kind of wrap up with some key takeaways at the end. So let's start with the challenge. There's a lot of switching and shopping activity in the P&C insurance industry in the U.S. And as a result, the industry is spending upwards of $20 billion a year on customer acquisition. They don't spend that much every year, depending on the year, but net, it's a lot of money. And so the question we want to help answer today is this: how can brands lower their customer acquisition costs and still meet their growth goals? And that's what we want to get at today. So in terms of the opportunity, we believe that with a very targeted approach using predictive analytics, that a insurance carrier could reduce their customer acquisition costs by as much as 50% and still hit the growth goals in terms of number of new customers. So moving from kind of traditional marketing to targeted marketing. So it's a big number, and you can either take those savings and drop them to the bottom line or use them for other purposes, or you could accelerate your growth and set your growth goals higher using the same amount of budget, or maybe some combination of those two strategies. But the question is, how do we do this? Before we dive into it, Steve, I want to just kind of level set in terms of why JD Power and our expertise in customer acquisition. And we have been doing quite a bit of research in insurance shopping over the years, and we have kind of a newer solution that's more kind of real time in terms of shopper intelligence, right?
Yeah, we spent almost 20 years dialed in on what is driving consumer behavior around shopping for auto insurance. And coincidentally, when most people are shopping for auto insurance, they're shopping for some other product too. They're either shopping for a home policy or a renter's policy, umbrella, or something else. So in this work, we're not just looking at auto insurance shopping, but we start there and say, okay, if you're shopping for auto, what's going on? What made you go to market? What were you looking for when you were in market? Who did you get a quote from? Who did you buy from? The channels you used, the information you were gathering, all of those things. And then we've been doing for a long time, work like Ken does around modeling what made you move through the funnel. Because of course, if we ask consumers, why did you buy? They'll say it's all around price. But we find that things that are aside from price are actually more influential in conversion through the funnel than price itself. So in that shopping study, it's likely our most data-rich study at JD Power across different practices. Very rich data set around all the things that are driving, influencing, and the results of shopping for insurance. So you think about the key factors right now that are influencing consumers. Brand is a big one. How do brands portray themselves in the market. We've seen in recent work that trust around an insurer is critical to driving satisfaction, but also to closing a sale. Does the consumer trust your brand? And obviously, your acquisition strategies can influence that. The distribution channels you're using, how are you quoting customers? How are you binding the policy with customers? Are you meeting them where they are? The quote process is really critical, especially today where the last couple of years we've seen premiums going up so rapidly. How do you expose the customer to that quote? How do you prove the value for the price that the customer is paying during that quote process? The policy offerings, and as we talked about price, all things that are influencing shopping behavior today. And then about 5 years ago, we said, well, it's great that we're doing this really in-depth work on an annual basis, but we want to look more in a timely fashion at what consumers are doing. So starting around 5 years ago, we created the List product, where we're surveying now 1,000 consumers a day in the US, and likely going to be increasing that here in the near future, even more consumers on a daily basis. Asking about their shopping behaviors for auto, homeowners, or renters insurance. Some of the depth around what we have in ISS, not quite as much, but a lot of information around what is driving people out to market, who are they quoting, are they switching, a number of demographics about the household, so that we can better understand where are the key opportunities for insurers right now to win their target customer.
Terrific. Thanks so much, Steve. So what we want to focus on today is this idea of targeted marketing. So how can we reduce customer acquisition costs with targeted marketing? And I want to introduce this term called lead scoring. So the idea that you can take a marketing list of prospects and actually identify in that marketing list which are the most likely to actually switch. Even better, which are the most likely to switch to our brand and meeting our underwriting guidelines. And then even better, it would be helpful to understand, once we identify this group that is likely to switch, can we actually identify the marketing messages that would resonate the most with the group? So that's the challenge is how do you take that prospect universe and really kind of narrow it down to the group of best prospects. We know that marketers have been doing this for a long time, and we think there's now, with the introduction of machine learning and AI and other tools for building better models, there's an even better way to do it. So that's what we wanted to kind of talk through today. So what do we have to answer for lead scoring? So first of all, we have to identify who we're going to target, and then what is the messaging that will act as the catalyst for them to convert. If you're going to run a campaign around lead scoring or introduce this idea of lead scoring into your current acquisition spend, another question you have to answer is how much are we going to invest? And then finally, how do we know if we're successful? So those are the questions you want to be asking yourself and your team. So let's start with the first question. How do we score their prospective leads? So we want to introduce another term called propensity to switch. And so the idea is that when you look at the population of your prospects, there's going to be different levels of their propensity to switch, which just means they're more likely to switch than to not switch. And what we're proposing is you kind of identify that part of the population curve that has high propensity to switch and to target those prospects. So then the question is, okay, how do we quantify propensity to switch at the prospect level? And so we know that there are certain drivers that make it more likely that somebody's going to switch than not. So Ken, maybe from the data scientist point of view, if you could just kind of provide us your perspective on this challenge of scoring prospective leads and quantifying propensity to switch.
Yeah, definitely. So like Steve mentioned, you can have a ton of data, but it's not necessarily having a lot of data that matters, it's having the right data that matters. So this approach that we took here was twofold. So one was using kind of the history and what we know of the insurance market, why people change, we identified the key factors initially. This is kind of what every carrier can do, and historically have been doing. Then taking that kind of those factors using like a more traditional statistical approach, we augment that with machine learning, with AI, to identify who are the people that are most likely to switch. And we use a number of different factors, let's say just pure demographic factors. And then on top of that, we also use a lot of behavioral data that only exists or that we have the best access to. So some example demographics, as you see, are things like age and education, how many drivers are in their household. And then also some behavioral factors here are bundling. So if you have also bundle your car with your home, what's your credit history look like, what's your driving history look like, and a number of other factors that we're not going to go too deep into the details. But once we're able to get all those components together, we're able to quantify who are the people that are most likely to switch.
So then the next question is, once we've identified this group and really kind of have narrowed our prospect list to those who are most likely to switch, the next question is, what are the marketing messages that are going to resonate with them? Before actually we dive into that question, Ken, I think we actually have just kind of like what an example model would look like in terms of taking the population and kind of splitting it by propensity, right?
Yeah. So basically, what our model will shoot out is basically like a probability of one person switching from one insurance carrier to the next. And then from that point on, we can kind of bundle them into what we're going to call 5 different categories. And you'll see kind of the order here from the top right and the kind of in a circle to the bright green. And we split this in terms of like what's the average, what are people that are very unlikely and like almost impossible to switch carriers versus those that are the most likely to switch. And you'll see on the right side, the 2 lightest colored greens are those that are under kind of the average or under the average population in terms of the probability or propensity to switch. And we see over 50% of carriers or prospects are unlikely to switch carriers. We take then the next slice, which is like what we call our average people most likely to switch. We find that to be about 19-20% of the population, at least with the data that we currently have. And then we kind of transition over, and the key one is this bright green at the very top. These are the prospects that have over a 2x plus chance of switching carriers, and this is really the top 5%, where these are probably the people that you want to target. And if I were in anyone's shoes, I would much rather target someone that has a 2x chance of switching than someone who has a less than 1% chance of switching, which is going to be that light gray or light green.
Yeah, so I suppose that one of the important reasons to segment this way is that obviously that bright green slice of the pie where that's twice the chance of switching carriers is who we want to go after. But what if that group isn't big enough and you've got growth goals that you're trying to achieve? By doing this segmentation, you can actually then just work what was that counterclockwise and go to the next group, which it's not 2x, but it's still above average, right, Ken?
Yep. And Mike, if I want to add one more thing to that, if we're thinking about it from a long-term perspective, these aren't deterministic clusters. These are clusters at this point in time. So someone that may be in this light green can eventually down the line be in this bright green as well too. So maybe I don't want to invest a lot of money into them, currently, but from a brand perspective, I want them to be in their ear for a little bit now, so that maybe when they are willing to switch, a year from now, 2 years from now, I'm a carrier that you've heard about, and therefore, when I am ready to switch, I'm able to target you, and I have a leg up on everyone else.
Yeah, that's a good point. I think that also is going to work for the carriers who have kind of a nurturing strategy. So perhaps they aren't targeting somebody to switch within the next 90 days, but they do want to start sending nurturing messages so that a year from now they can target them to actually switch. So, okay, thanks for that. All right, now let me get back to the second question, which is once we've identified the group we want to go after, how do we know what marketing messages are going to resonate and really perform, with that group? So Ken, to get at this, we use something called cluster analysis. Is that right?
Yeah, so there's a lot of different terms, but cluster analysis is the one that makes the most amount of sense. Um, the best way to think about it, like in a very kind of empirical way, is if you think, let's say, going back to high school, who did you have lunch with? Were you with, the jocks? Were you with the ASB crowd? Were you with, the nerds? Self-appointed nerd. I was definitely in that group. Um, so if you're in that group, what are some patterns that make sense to you? What are the messages that are going to resonate? What are the ones that I really care about? And if I could target messages based on kind of what clique or what group or like what tribe I'm in, then I have a much better chance of success.
So
Yeah.
Ken, what are some examples of marketing messages that could be applied to the different clusters?
Mhm.
Just based on the research that we've done. We don't want to give any secret sauce away here, but just generally.
Yeah, so we want to focus a lot on the behavioral components here of like, okay, within this group, they're most likely to have had some sort of interaction with the claim and the price, for example. And this is, again, a very general one. And I don't want to get into the crazy deep ones that we've seen yet.
Mm-hmm.
But it's never going to be a one factor component. It's going to be a combination of components or factors that make sense. So what we would tell like a carrier is say, okay, this group, you want to focus the message around the pricing, around their, let's say, some sort of claim that may have happened for them in the last year or so, and then discuss with them about that and have a conversation around that instead, because that's a problem. That's what they're most likely to be concerned about.
Yeah, so I think the key takeaway here is that with lead scoring, not only do you get a kind of a score or a ranking for each prospect, you're also getting kind of a one-to-one messaging match. So for each individual prospect, you'll know which message would resonate the most. Wanted to, before we kind of dive into how to activate a campaign or this strategy, just wanted to talk about a pro tip for lead scoring. So if you're doing this already, how can you take it to the next level? And so, Steve, we know from conversations with the insurance companies that it's not only important to identify the prospects who are more likely to switch, but it's even more helpful to know if they meet your underwriting guidelines, right? Because that's going to get you, in the end, those two things together get you to the lowest cost to bind.
Yeah, exactly, Mike. The recent hard market that we in auto that we might be exiting, certainly not even close to exiting in home insurance yet, has I guess reinstilled in some insurers' minds the importance of underwriting. We've seen some tightening of underwriting guidelines in both auto and home, and I think we're going to see as consumers have really returned to market, as you said at the opening, in the second half of last year, and they're continuing to do so this year, that while insurers are looking to grow, they want to still grow profitably. They don't want to go back to the times they were in a couple years back. They want to find the right prospect, the right customer who will be a high value customer for them the way they do business. So what's right for one insurer might not be right for another. So it's not just a simple one size fits all. What is the right prospect for you? And that's where modeling like this can really help, so that we know what type of customer insurer A is chasing after, what's the right kind of customer for their underwriting guidelines, and then match that with the people that are most likely to switch, and do that differently for insurer B that has a different profile that they're looking for.
Okay, so the benefit here is number one, your marketing ROI overall is just going to be better in the end when you get to the end of the year and look at how effective it was in terms of actually getting to the prospect to come in and get the quote and then actually get them to bind. So you're going to be also kind of eliminating any marketing spend that would have been wasted on people who didn't qualify for underwriting. But the question is how do you do this? And I think one of the things we're finding is that it just often involves additional behavioral data to get at the underwriting piece of this, right?
Yeah, true. And I think that's also kind of what helps us really fit the right type of prospect for the insurer in question. Because to add on to what you just said, not only do you more likely to win them, but you're more likely to retain them for the foreseeable future. And I think that's really important for auto and homeowners carriers right now to write policies that are not going to be lost a year or two from now, that it's the right type of customer to be retained in the book, represent the right type of loss profile, et cetera, to be a profitable customer long term.
Okay, thanks, Steve. All right, so let's talk about how you get started with something like this. And why don't we couch it in the framework of a 120-day pilot test? So, Ken, I'm just going to walk through this, and I'd love for you to kind of jump in and provide some color here. But at a very high level, you want to start with a model, right? A lead scoring model. So you can build this model yourself with your data science team, or you can rent a model. So here at JD Power, we've actually built a model that does lead scoring using our data across the entire industry, studying shoppers over the course of the year, and also this kind of daily shopping intelligence that we have. So that model is going to analyze your prospects. It's going to identify the prospects with a high propensity to switch. And then from that same model, you can use cluster analysis to identify key conversion messages. So then you take that and you're going to want to run some test acquisition campaigns. Our recommendation is that you run more than one, right? So you want to test different um, approaches to lead scoring. You want to run different test messaging. So you want to identify your test group or groups and then leave the rest of the prospects as control. Run those test acquisition campaigns using the key messages identified from the cluster analysis. And then at the end of the pilot, you can measure conversion of the test group or test groups and then compare that to the control group. And then from there, you can use the data to build a business case to either run another pilot, or if it's really super successful, just scale from there. So, Ken, why don't you provide that kind of data science perspective on this, and then Steve, maybe the more practical business perspective.
Um, yeah, sure. So from the model side, I think it's also important to continuously iterate over time. So what a model that works great today may not work well tomorrow. So there needs to be kind of a what we call a hub and spoke model approach, which is let's continuously improve, let's continuously modify our models over time. Because again, what works generically for one group of people may not work for another. What works for one carrier may not work for another. In terms of the test acquisition campaigns, a really good A/B test is really crucial in this pilot. You can have multiple test groups, as Mike suggested. So you can have, let's say, condition A, condition B, condition C, and those could be results from three different, let's say, models. It could be, let's say, you're really confident in the model, three different marketing messages, and then the evaluation is that's where the classical statistical analysis comes in. That's my bread and butter. It's things that I love, and that's just fun for me. So really, you can start this off very simply with the t-test, and then as you scale, you can think about this as more of a stratified block design, and that can be a little bit more complex, and that'll allow you to account for kind of nuanced peer group differences, or kind of differences, let's say, between states or between regions, urban versus suburban, and so on and so forth.
Yeah, I think from the business perspective, the value of the pilot is that you'll learn something new. Even the model will make predictions and they might be very accurate, but we'll always learn something new during the pilot. We might see, as Ken said, an ABC test, that we're actually winning more of the target prospects with model C than with models A and B. And we really want to put more spend towards that. So it really allows for a much more informed business decision before making the larger spend that you'd make when you really scale up. So we recommend, in a very strong sense, a pilot like this to ensure that the models are A, performing like you want, B, that you're capturing the prospects you want, and C, have more numbers now to make better decisions before you really go out to scale.
Okay, thanks, guys. So why don't we just talk for a minute about the business case and the ROI for lead scoring? So on the left, we've got a scenario here that involves math. I'm not going to walk you through all the math, but essentially the idea is even if you spend upwards of $100 to score a lead, the return on investment is going to be enormous just in terms of improved conversion rate, but also your reduced customer acquisition costs. So I'll leave the math to a proof after class here. But the way to think about the ROI story, I'm sorry, when you're sharing this with your organization is number one, lead scoring is going to help you reduce your customer acquisition costs. You're focusing on your highest probability prospects. You're going to reduce wasteful spending on unqualified leads, and you'll see the results. We're saying 15 to 30% here in terms of reduction, but that could be as high as 50%, as we talked about at the beginning. Another way to think about this is that with lead scoring, you're going to increase your conversion rates because you're not spreading peanut butter anymore in terms of your marketing spend. You're focusing your marketing spend on the highest probability switchers, and then you're kind of matching that with the marketing messages that are most likely to resonate with them. So you can actually see conversion rates boost by 10 to 20%. Which also adds to the ROI story. And then, kind of secondarily, you will be acquiring higher value customers, which could increase the customer lifetime value, which then enhances profitability and offsets future acquisition costs. And then this one's pretty important, actually. It's faster time to revenue. So by being smarter and more targeted with your acquisition spend, you're going to get faster conversions. Faster conversions means improved cash flow and accelerating the ROI on their marketing efforts. So, Steve, any other thoughts here on the business case or the ROI story?
I think just what's hard to quantify up front when you're doing an acquisition model, but we'll have a separate webinar on. But I want to bring it up here is when you're acquiring the right customer, you're retaining that customer. So in the P&C space, a lot of what drives the financial outcomes of an insurer is their ability to retain their book of business. So acquiring the right prospect up front and retaining them for many years into the future, when you're using a model like this, you're more likely to get those home runs when you swing the bat and not just win a customer, but win the right one that is going to be going to fit your underwriting criteria and going to be on your books for years to come.
Okay, thanks, Steve. Okay, so just to wrap it up, key takeaways. So yeah, we talked about at the beginning, customer acquisition costs and spend is a really large problem for the industry, but it's also a large opportunity. Just reducing customer acquisition costs is going to save you money. It's going to enable faster growth. Running a lead scoring program, like we talked about today, is more effective than spreading peanut butter. So if you're not doing this, you should definitely be testing it. And you want to leverage what you know about your prospects to quantify those lead scores and match the key retention messages. That's something we talked about. And then finally, just getting started internally with that kind of honest internal conversation. Some of the questions you can ask would be, do we have an effective lead scoring program today? Are we identifying prospects with a high propensity to switch? Do we know what switching messages will resonate? And what can we learn from best practices? So Ken and Steve, would love you to kind of weigh in on the key takeaways, and then I've got a question for you guys.
Yeah, I think Mike, you hit it on the head here. The honest conversation is probably the most important part of this, in my opinion, and it's a question that would have to be iterative. You would probably want to think about this every, in regular cadence, whether it be quarterly, whether it be monthly. And seeing, hey, do things work? Especially the last bit of the switching messages. Like, do they work? If they don't, how do we fix it? How do we improve from it? How do we learn from it? And how do we not do it again?
Yeah, I would just add to that. We're in an environment, especially in auto insurance right now, where insurers had hoped to be for over 20 years. You think about all the massive increase in ad spend over the last 20 years to draw customers out to market, trying to get them to shop. And we're now in about 6 months into a cycle where we're seeing record shopping rates. So it might appear that, well, it's going to be easy to find prospects, but the smartest competitors out there are going to be doing the work to find the right prospects, send them the right message, and acquire them most cost effectively. And I just recommend look at an approach like this so that you're not just catching what's left behind by the stronger competitors out there.
All right, okay, thanks, guys. So here's a question, and Steve, we talked a little bit about this before we started the webinar today. You've been in the industry, you've led these kind of programs for an insurance carrier, and so Ken, the question is this: lead scoring, targeted marketing, running A/B tests, especially in the expensive arena of direct mail marketing, isn't necessarily a new idea. So just in terms of what we're talking about today, what is new? What are we seeing, especially with the advent of machine learning and AI? What kind of new capabilities are these newer models bringing to the table?
Yeah,
So that's,
I'll just
yeah, go
start
ahead.
off. Well,
Yeah, Steve, why don't you take it, and then we'll have Ken weigh in.
yeah, I'll start off with the what JD Power brings to bear that is accretive to this modeling is that behavioral data that Ken focused on earlier. With 20 years of history of watching what is bringing customers to market, what is influencing the decisions they're making, what is ultimately driving them to convert through the funnel. So it's one thing to be aware of the brand, the next to consider the brand, but what makes you actually take the action on your own part to go get a quote? And then when you're looking at, on average these days, 3.5 quotes across different competitors, what ultimately is driving the decision to buy the insurance? And who are making these decisions? What kind of folks are out shopping? Over the last couple of years, we've seen a diminishment in the quality of business that is out shopping. A lot of carriers have resultingly pulled back from the market and not wanted to acquire the businesses out there. So there's so many ways that the behavioral data and understanding more about the customer and what's motivating the customer can enhance the models that have been out there for quite some time.
I think on from a data side, what's been more what we're seeing more in the market is that carriers are interested in getting more data, but more data necessarily isn't better. The math behind all these models and what we see in AI has been around for quite a while now. It's just now that we have the computational power to actually kind of run these models the way that we have always imagined it to be. That being said, data is never going to be completely precise. If, for example, if you were to take 10 different people and ask 10 different people, what is love? You're going to get 10 different answers. So data is always going to be imprecise. And it's really important to get the right data. And if you think about kind of what JD Power has done over the last 20 or plus odd years, they really know customers, and you've developed kind of the right surveys, the right data collection methods over a period of time. And I think that's something that, as carriers are trying to get more and more data, this behavioral component is something that's going to be very difficult to capture correctly. And I think, that's one thing that is going to be new about how to use the behavioral data the right way when you have all this imprecision in spite of more advanced methods.
All right, thanks, guys. So Steve and Ken, thanks so much for joining us today. We want to thank everybody who joined the webinar today. At this point, we're going to hand it over to Carolyn to let you know how to find out more information and next steps. So, Carolyn.
Yep, thanks, Mike. If you jump on to the next slide, if anybody on the call has any additional questions or would like to discuss this topic further, we definitely encourage you to reach out to our team. And if you're interested in obtaining slides from this webinar, please reach out to one of the account representatives on this slide here. Their contact information is available. We also invite you to visit our website for more information about insurance intelligence solutions and join our mailing list so you can have more content just like this. Thanks again, and we look forward to connecting with you soon.